Ever wondered if owning more than one property could actually help you save money on your taxes? Many people dream of a vacation home or a quiet retreat, and it is a common question whether such an investment offers financial benefits beyond personal enjoyment. Yes, in most cases, you can deduct mortgage interest paid on a second home. The Internal Revenue Service allows taxpayers to deduct interest on mortgages for both a main home and one other qualified residence, subject to certain limitations. The core reason for this deduction lies in the definition of a qualified residence. For tax purposes, this generally includes your main home plus one other home that you choose. The interest is deductible on the first $750,000 of combined mortgage debt used to buy, build, or substantially improve these qualified residences. This limit applies to loans taken out after December 14, 2017. For loans taken out before December 15, 2017, the limit was $1 million. This deduction applies to both your primary mortgage and any home equity loans or lines of credit on these properties, provided the funds were used for acquisition or improvement. To ensure you can claim this deduction, first, keep meticulous records of all interest paid on your second home's mortgage, which your lender will typically report on Form 1098. If your second home is sometimes rented out, you must also carefully track your personal use days versus rental days. For a property to be considered a second home and not a rental property for interest deduction purposes, your personal use of the home must exceed the greater of 14 days or 10% of the total days the home is rented out at a fair rental price. Always consult a qualified tax professional to navigate these rules and maximize your potential benefits, as specific situations can introduce additional complexities. This benefit is officially known as qualified residence interest, and it is a significant tax provision. It recognizes that a second home can represent a substantial personal investment, similar to a primary residence. Understanding the distinction between a true second home, which is used personally for a meaningful period, and a pure rental property, which falls under different tax rules for rental income and expenses, is vital for claiming the correct deductions. Ultimately, the ability to deduct mortgage interest on a second home can make ownership more financially feasible, reducing your overall taxable income. By understanding the qualified residence criteria, adhering to loan amount limits, and keeping precise records, you can confidently leverage this valuable tax benefit. It rewards careful planning and diligent record keeping, transforming your second home into not just a personal haven but also a smart financial decision.